I spent a lot of time learning the RSI and the MACD when I first started out. In fact, it was one of the first strategies that I was taught. And anybody that's starting out in day trading, if you just looked online, top trading strategies, MACD and the RSI are definitely the number one indicators that pop up for newer traders to use. But I was just never able to get consistently profitable with them until I understood what I'm going to share with you guys in this video today. And once I learned this, I ended up actually removing one of these two indicators here, and one has stuck with me for my 8 years as a full-time trader now. And I've completely mastered it and learned some really unique things about it that I'm going to share with you guys. And the other one has gone to the wayside, and for a very good reason. I mean, if you simply just look at this chart and you look at the information that's shared on how to read the RSI, for instance, online, it tells you that you've got to sell when we're in overbought conditions above 70 or buy when we're in oversold conditions below 30. And if you just simply look at this chart, you'll see how horrible that is in regards to exit signals. It gets you out super early in uptrends, and it gets you into the market when we're weakening and rolling towards the downside. If we look at these entries here, price ends up rolling back underneath those previous lows again and again here as well, stopping you out. And this is why many would argue that they've paired up the MACD with it, that the MACD establishes a better trend with its MACD cross. But even that strategy online pairs it up with the RSI to sell when we're above the 70 zone again. And if you look at where the MACD crossover gets you in at, this MACD crossover also gets you out super early. So here's our MACD crossover on the bottom side, and then the MACD crossover on the top side. And then we don't come back down underneath the zero line again until all the way over here, which again gets you in too early and gets you out with very little gain for the amount of time that you spent in this trade here. Now, this video is not to say that you can't be profitable with MACD and RSI. That's not the scope of this video. I 100% believe that there are profitable strategies with using MACD and RSI, and that anybody that spends enough time mastering any indicator can become profitable with it. However, there are indicators that are paired together that are much more efficient and much more effective and give much stronger signals and much more frequent stronger signals as well than ones like the RSI and MACD paired together. And the fundamental reason for that is that the MACD and the RSI are both based off of lagging information. So they're lagging indicators at their core. And now some would argue that RSI has a leading aspect to it, such as reversal divergences, but it's still based off of previous price, and therefore it's still lagging information, even if it's a signal that precedes a top, therefore being predictive. And if I were using MACD and RSI together, it would certainly be a better use of using them together, using a leading aspect from one of them and a lagging aspect from the other, such as the MACD crossover paired up with reversal divergence to pick tops. That would definitely clean out a lot of the noise that we get from false signals from MACD and RSI being paired together. But the basic information that's being presented online is very misleading, and it's the number one reason I wasn't able to become profitable with these two indicators when I first started, and profitable consistently, which is what we're all striving at the end of the day to become, is consistently profitable traders. And I've figured out how to create that consistency over the last 8 years now, and it boils down to this core concept that technical analysis breaks into 4 different categories. And if you use tools from each of those 4 categories, you get the strongest strategies and the most reliable signals. So here's the 4 categories that we want to be pairing tools from. We've got lagging indicators, leading indicators and tools, patterns, and then price action. Now, one concept that we want to understand here is that everything about the markets is based off of price action. That's the core of the markets, is buyers and sellers. It's what creates everything else that these lagging and leading indicators and tools are used of, patterns that form in the markets, everything. So we want to understand price action as a foundation, in my opinion, for any trader. They should be able to understand market movements from a naked chart. And although there are some traders that trade just smart money concepts alone or trade just footprint charts, it's only one tool out of the 4 categories. And so those strategies would be much more effective if they paired footprint charts with Fibonacci or footprint charts with TDI, right? Something for another tool from these other categories. And the most effective strategies are going to incorporate one from each of them. So a total of 4 here. The ones in green are the ones that I use: TDI, Fibonacci, Elliott Wave, and Smart Money Concepts, that I've built 9 strategies around that are circulating, meaning that they allow me to trend trade, counter trend trade, breakout trade, and pullback trade as well. And this is super complementary because when a pullback strategy gets missed, I can capitalize on a breakout strategy. And if I've got a really nice position on the long side, I can use a counter trend strategy to hedge my bets. So not only have I created more of a circular trading system, but I've done it using a tool from each of these categories, so it's extremely complementary rather than describing or repeating the same information. If we go back to the charts here, we can even see that with MACD and RSI, they even move similar together. The up and down motions of the histogram with the RSI, the divergences that get formed on both the MACD crossovers as well as on the histogram as well. And anytime that we're dealing with lagging indicators, they're so much easier to see in hindsight when after the information's already printed, like what I'm showing you guys on this chart here. But if we were to go back and look at this in real time, it's simply not as clean. It's getting you in towards the top of a candle, and you're getting more false noise in real time than when we go back and we look at previous price paired up with the indicator now and these crossovers. So instead, a much more effective way is to drop the MACD altogether, because RSI, for one, is the indicator that has stuck with me for my entire career now. This is the indicator that I've completely mastered. I found some really unique things about it that I'm going to share with you guys in another video that I'll probably end up pinning up here for you guys to watch at a later date here. And I'll even have another video that I'll pin at the end of this one that will be a full breakdown of one of my strategies for beginners, and then I'll have another one for more advanced traders that uses multiple components of TA there. So definitely make sure to check those ones out, you guys. And if you're not subscribed to the channel, definitely subscribe as well so that you get dinged and notified when I'm releasing those videos every Wednesday and Friday. Okay. But I quickly want to show you, to end off this video here, how having and utilizing a tool from each of those components allows us to understand market movements much more effectively and capitalize on the entire run up here. So first off is understanding that the RSI indicator is actually a really great trend identification tool. And that's because it ranges between 0 to 100. So if we look at TDI or RSI, anytime that we're using 40 to 50 as support and ranging all the way up to 100, that's going to be considered an uptrend. So you can see here on our RSI that we're ranging between 100 and 40. So every time we come back to 40 is actually a buy opportunity. And anytime we're above 70, that is not a sell signal for us. This is a sign of strength, is for us to be in that. So that information is very misleading online in regards to selling when we're above the 70 mark. In fact, if you're trading with the trend, being above 70 is ideal. We don't want to see it come underneath that or get rejected from the 60, 70 pocket instead. Okay, so if we take a look at each one of these lows here, we can see that we ended up buying or having buy signals on each one of these lows here across the board. And then if we use Elliott Wave as a pattern identification system, we can see that the type of structure that we're starting here is going to end up being a 5-wave move. And that's going to be ideally based on the previous price patterns as well back here. But nonetheless, when we're looking for a 5-wave move, I can use Fibonacci with relationships to Elliott Wave to give me upside targets to get out at. 1.618 and 2.236 are two of my favorites that I look for just regular Fibonacci extensions to highlight Elliott Wave here. And so when we're actually in this territory, now I can look for reversal divergence. And my reversal divergence, I don't care about anything above 70. I want the reversal divergence that actually gets rejected at 60, 70. So now I get a much stronger signal here for the reversal divergence on these two highs here in relation to Elliott Wave. in relation to Fibonacci, and I can ignore all the noise that's going to end up happening right in here, that the MACD would have gotten you out early on, that the RSI would have gotten you out early on if you listened to the regular information online about selling when you're over 70 and so forth. So it's a much more effective strategy pairing these components together rather than stacking tools in the same category that basically describe each other, like MACD and the RSI. Again, not saying that you can't have a profitable strategy with it, but there's certainly much more effective ways to create strategies. And if you're looking for a strategy, this is a great way to actually measure how strong that strategy is. If somebody's using a strategy that's simply smart money concepts, well, we know there's definitely some room for there to be stronger signals and more effective understanding about the market if we were to incorporate a tool from each of the other categories. Again, I'm going to pin videos at the end of this video here going over a breakdown of my more advanced strategy and then a simpler strategy just using smart money concept, because for newer traders, it is more effective to establish habits and behaviors and consistency off of just mastering one tool in one category first and then building upon that. And that first tool should really be the smart money concepts or anything within that price action side of things. Japanese candlesticks, naked chart pattern trading, any of that stuff would be a great first step for beginners. And then for those that have been doing this for years, struggling and not seeing consistent results, now you understand how to pair these up more effectively and why you've likely been getting poor results from previous strategies that have just been stacking the same indicators basically. Thanks so much for tuning in and watching, guys. Much love and take care.